Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let's talk about that. You're getting $2 as a credit. That credit is yours to keep no matter what. Stock goes up, stock goes down, premium stays in your pocket no matter what. The obligation is also there, though. That's the bad news about the premium staying in your pocket. The risk is only $3 is because it's mathematically impossible for you to lose more than $3. Let's say the stock went to zero. You would make $1 on the call spread. So if the stock's at zero, you're going to be ahead $1 on the call spread. You also get to keep that other $1 that you got as a credit for the put spread. So that's the $2 credit that you would get to keep even if the stock went to zero. However, if the stock goes to zero, you're obligated those $5 on that put spread. 5 minus 2 is 3. That's how you can lose $3 to the downside. Now, how can you lose $3 to the upside? Well, if the stock goes to 1,000,000, let's say, you'll make $1 on that bull put spread because those puts will expire worthless. You'll also get to keep the $1 from that bear call credit spread. That comes out to $2 when you add it all up. Now, the bad news is that you're going to be obligated that $5 difference between the two strike prices on the call spread. 5 minus 2 is 3. That's how you can lose $3. If the stock expires in the middle, between 50 and 60, then all the options expire worthless, and that's where you make your profits. It's mathematically impossible to lose on both sides of this trade. The only way that you can lose on both sides of this trade is if you over-adjust, meaning you get out of the call spread when you're losing on the call spread, then you get out of the put spread when you're losing on the put spread before expiration, or you do something like that. So long as you don't do that, then you won't lose on both sides of the trade. It's mathematically impossible. Exchanges do recognize this, and they only require margin for one side of the trade. Or that's the way that we do it at our brokerage. Most brokerages are like that now. There are some that are still requiring margin on both sides of it. If you're looking to be a Condor trader and you want to take advantage of this, make sure that you're at a brokerage that recognizes the proper margin requirements for Condors. Now, if you want to have non-leveraged Condors, you can do that, and I don't have a problem with that if you want to have a little bit extra, but just understand you're not taking advantage of one of the benefits of the Condor. Now, with that, in terms of leverage, does that mean that I'm saying to leverage as much as you possibly can? Absolutely not. I don't mean that even a little bit. You'll see with our models here in a little bit that we don't believe in that at all. But if you can put the rest of that money into a government treasury or something that you deem as a lesser risk, why would you not want it there? And why would you want to have it in Condor margin requirements? So what I'm saying is that even if you're a very risk-averse leveraged person, which I am myself, you're missing out on government treasury rates. Now, I know a lot of you are saying, ooh, big deal on the other end of it, but if interest rates ever do come back, this could be a big issue for you, and you could be using your money elsewhere, just depending on how you set it up. The bottom line is it's a tool. With that, we just showed or talked about how this can be done with XYZ stock. Let's actually put this into practice right now. All right, just to kind of rehash what I showed real quick, where I'm at under the quotes, option chains, and I typed in EUI, and that's where we're at right now. Okay, so right now we're seeing EUI as the underlying, and let's say that we believe that, in fact, let's actually go out a couple months. Let's go out to October. What we're going to do right now, our sentiment is until October on the euro, let's say. And what we're going to do, we're going to go ahead and sell the 68 put to start with. You can click once for buy, twice for sell. And then we're going to go up to 72 for the, in fact, let's actually go up to 73. We click twice for sell. These are the short strikes with which we're going to use in this demonstration. Now, just to show you some other things in here, I want to show you the Greeks on here. When you drag your mouse over the symbol for the underlying, you can actually see the Greeks. Now, typically our rule, we like to go out to a 7 delta when we're doing our condors, but nonetheless, you're seeing we have a 32 delta on the call side, and we have a 27 delta on the put side. So approximately, this is probably tighter than what we would usually do, but nonetheless, I just want to show you how this concept can work. We're then going to buy the 74 call as a hedge leg, and we're going to buy the 67 put as a hedge leg. So with this, in terms of, first off, let's actually show the risk reward on this. We're going to go to the trade calculator. And I'm going to click calculate. I just want to first show the risk reward up here in the upper right-hand corner. In this case, if you're doing this with just a one lot, you're risking $66 for the potential to make $34. Now that's a 50% rate of return. I don't know about you, but I could live off of that. The problem is that you have this petty problem that you actually have to be right every time to actually get that. What I'm showing you, if you're looking at this and thinking, oh, I'm going to make a 50% rate of return between now and the middle of October just by doing this trade that Mike showed me. If you plan on doing that and that alone, plan on losing a lot of money in the marketplace if that is all you do. But I do want to show you the potential as to how this works. Now, how would you enter a trade like this through our platform? What we would do is we would click the buy and sell, the specific strike prices that we would do. We'd click trade, and this is entered as a four-legged trade all at the same time. All you'd have to do is type in the quantities that you would want for that specific trade. This is a very simple trade that you would be able to do on our platform and pretty much any brokerage platform. A lot of brokerages are recognizing the Condor right now as a specific trade. This goes to the exchange as a Condor. So you don't have to worry about getting filled on the 68 put and the 74 call, and then that's it. It goes to the exchange as a Condor itself. So let's say, for example, that you're worried that the Condor is going to force you to be naked. It won't work that way. You could get a partial fill, but the partial fill would be filled on a 4x4 basis, meaning that let's say you put in a 10 by 10 by 10 by 10 Condor, you might get filled on 2 by 2 by 2 by 2, but you'll always have the Condor actually in place. Now let's go back to the presentation and just finish up with a few things, then we'll open it up for questions. Some other thoughts that I want to talk with you about. Leverage. Only the trader, the investor, or the advisor can help you in terms of making a decision on what level of leverage to do. If you go all in and put all your money into a Condor and leverage yourself to the hilt, it'll work great when you're right, but when you're wrong, it's going to hurt, and it's going to hurt bad. Never fear the market, but always respect the market. Now, for some people, they're comfortable with a small level of leverage. I'd be fine with a little bit of leverage. However, understand that it's a calculated risk that needs to be underlined when doing this.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.